When a company acquires inventory, accounting principles dictate it is initially recorded on the balance sheet at exactly what it costs to acquire or produce. But the actual economic utility of physical goods is not static. Over time, the value those goods hold for a business can steeply decline. This loss of utility happens for several predictable reasons. Inventory might suffer physical damage, slowly deteriorate in a warehouse, become technologically obsolete, or suddenly fall out of favor due to shifting consumer demand. When this happens, a strict accounting consequence follows. If the real-world utility of the inventory drops below its original historical cost, the carrying value on the balance sheet must be written down to reflect that new reality. Recognizing this loss immediately, rather than delaying until the inventory is eventually sold, forces the company to absorb the financial hit in the exact period the decline occurred. This ensures they cannot artificially inflate current asset values. Under U.S. GAAP, there is a major regulatory complication to this process. The rules for calculating an inventory write-down are not universal. The precise mathematical method a company must use depends entirely on the initial cost flow assumption they chose for their inventory. If a company uses FIFO or average cost, they follow the more modern, streamlined method known as lower of cost or net realizable value, or LCNRV. However, if a company uses LIFO or the retail inventory method, they are required to use an older, highly constrained model known as lower of cost or market, or LCM. Both methods aim to measure the exact same economic loss, but because LIFO operates differently under the hood, it requires a complex set of boundaries to prevent earnings manipulation. That boundary system is the core of our technical analysis. To apply the LCM model under LIFO, we first need to define the term market. By default, market starts as the current replacement cost of the inventory. Using unconstrained replacement costs is dangerous. Supplier prices can swing wildly, which would allow companies to manipulate their reported losses across different financial periods. To restrict this, GAAP imposes a hard upper boundary. The designated market value can never exceed the ceiling, which is defined as the net realizable value, the estimated selling price minus any predictable costs of completion and disposal. The ceiling prevents companies from overstating obsolete inventory on balance sheets and deferring inevitable losses. GAAP also imposes a lower boundary, the floor. Market value cannot drop below net realizable value minus a normal profit margin. The floor serves a different purpose. It stops a company from recognizing an excessively large artificial loss in the current year, just to report massively inflated profit margins when the inventory finally sells next year. With the boundaries set, the ultimate algorithmic rule becomes clear. To find the true market value under LIFO, you analyze three numbers: the ceiling, the floor, and the current replacement cost, and you select the middle value. Establishing these strict mathematical guardrails neutralizes the inherent volatility of replacement costs, forcing the recognized market value to reflect true economic utility. Let's apply this algorithm to a practical dataset. We'll isolate item A. First, calculate the ceiling, or NRV. The $80 estimated selling price minus the $20 cost of completion and $6 cost of disposal sets our ceiling at $54. Next, establish the floor. Take that $54 NRV and subtract the $3 normal profit margin, giving us a floor of $51. With boundaries set between 51 and 54, we introduce the current replacement cost, which sets at $53. We then apply the heuristic and line up our three figures. We have the $54 ceiling, the $53 replacement cost, and the $51 floor. Because 53 sits comfortably in the middle, it passes the boundary test and becomes our designated market amount. Finally, we compare this validated market utility of $53 against the original historical cost of $50. The historical cost is still lower than the current market utility. Therefore, the asset is not impaired. No write-down is necessary, and item A remains on the balance sheet at $50. Now let's look at item B, a scenario where the replacement cost fails the boundary test. Running the same initial math gives us a ceiling of 65 and a floor of 58. But here, the current replacement cost has dropped to 55. This falls strictly below our 58 floor. Because 55 is outside the acceptable zone, the algorithm rejects it. We look at our three numbers, 65, 58, and 55, and select the middle value. The accepted market amount snaps up to the floor of $58. We compare this new market value of $58 to item B's historical cost, which is $60. The calculated market utility is now lower than the recorded cost. This strict relationship triggers a mandatory write-down of $2 per unit. Look at this multiple-choice data block for a single unit of inventory. With practice, you can apply this logic rapidly to unstructured data. Parse the inputs to build the bounds. The $22 selling price minus $2 in selling costs yields a $20 ceiling. Subtract the $5 profit margin and you have a $15 floor. The replacement cost sits at $10. Between 20, 15, and 10, the middle value is 15. The replacement cost was too low, forcing a snap to the floor. Mastering this sorting algorithm allows for instant, objective valuation of LIFO inventory. Once the per-unit calculations are finished, the aggregate loss must be mapped onto the company's financial statements. This summary from Lala Company shows a finalized discrepancy. Their total inventory cost is $100,000, but the total calculated market value is only $85,000, creating a $15,000 write-down. By default, this $15,000 loss is not isolated. GAAP rules generally direct accountants to bury the impairment as a component of cost of goods sold. There is, however, a critical exception, driven by materiality. If the impairment is so large it is deemed material to the company's financial health, it must be extracted from cost of goods sold. The loss is then presented as a separate, highly visible line item on the income statement to guarantee transparency for investors. When inventory is written down below cost, the principle of permanence takes effect. That reduced amount becomes the permanent new cost basis for annual statements. Even if market prices fully recover a year later, reversing the write-down in subsequent annual periods is strictly prohibited under U.S. GAAP. The only nuance to this rule occurs during quarterly or interim reporting. If a market decline occurs in the first quarter, but management reasonably anticipates that prices will recover by year-end, the write-down can be legally deferred on those interim statements. But if the interim drop is considered non-temporary, the deferral is denied and the loss must be recognized immediately in that specific quarter. If a recognized loss reverses course and recovers in a later quarter of the same fiscal year, a gain can be recognized. However, that gain is strictly capped. It can never exceed the amount of the previously recognized loss. Whether it's applying the rigid mathematical boundaries of LIFO's LCM model or enforcing the strict permanence of a new cost basis, the entire subsequent measurement framework exists to enforce conservative valuation. It ensures that management cannot disguise a true loss of utility or manipulate